If you are planning to retire on SGX dividends, the sanctuary you have built might have a massive hole in the roof you have not noticed yet. This week, we are seeing retail investors gamble their hard-earned capital on small-cap momentum, while blue chips fail to even match the risk-free return of your CPF. I am going to show you exactly why chasing today's gainers could evaporate 75% of your position in a single market correction. This is the forensic breakdown of the SGX weekly gainers and losers for April 12, 2026. Looking at the macro pulse on this second slide, we see a market that is hesitating. The Straits Times Index reached a psychological peak of 4,996.05 on April 7th, but it just could not hold that 5,000-point handle. We closed the week at 4,989.41. This hesitation shows a clear standoff between retail fear of missing out and institutional profit-taking. Regionally, the Hang Seng was a roller coaster with a 777-point swing. But the real trigger for Singapore investors happened on April 9th, when the T-bill auction cutoff yield hit 1.47%. With the risk-free rate bottoming out, capital is rotating into equities, but it is doing so with a dangerous disregard for valuation floors. Now let us look at our featured gainer, Oiltek International. On this third slide, you can see a massive red flag. The stock closed at 2 Singapore dollars and 1 cent, which gives it a trailing PE ratio of 87.8 times earnings. To put that in perspective, the historical average for this company is around 20 times. We are talking about a valuation that is 4 times its norm. While peers like Cetrium trade at far more conservative multiples, Oiltek has become a primary beneficiary of what I call T-bill boredom. Buying a biodiesel equipment maker at 87 times earnings is like paying for a Mercedes and receiving a bicycle. Momentum is a guest that never stays for breakfast, and right now the bill is looking very expensive. The fourth slide breaks down the actual wallet impact for you. This is not just a theoretical number on a screen. If we see even a 10% softening in biodiesel demand, a mean reversion back to that historical 20 times PE would result in a capital drawdown of approximately 75%. So what does this mean for you? If you are a 55-year-old investor near retirement with a $50,000 position, a sudden reversal in palm oil prices could see $37,500 of your principal evaporate. For someone looking for a sanctuary, this is not an investment. It is a high-stakes gamble that your retirement portfolio is simply not equipped to handle. Moving to slide 5, we see Yangtze Maritime, which saw a 20.2% move this week. The price is tied tightly to the shipbuilding cycle, and while those cyclical tailwinds are real, we are facing a bit of a forensic fog here. There is a data gap in the verified valuation, with a reported PE of 13.3 times that needs more audit. For the heartland investor, the wallet impact remains purely speculative, until we can get a proper look at the upcoming debt wall audit. Cyclical speculation can be rewarding, but without verified data, you are flying through a storm without a radar. On slide 6, we have Centurion Corporation, up 14.4%. This is what I call a yield mirage. The stock moved higher on expectations for net property income growth, but the trailing yield has dropped to just 2.40%. That price growth is masking a return that sits well below my forensic floor of 3.2%, and it is far below the 4.0% you get from your CPF special account. This is a net loss in real purchasing power. You are taking on equity risk to earn less than a government-guaranteed account. Let that sink in before you chase the green candles. Slide 7 shows Delphi Limited, which jumped 19.4% on very light volume. This is classic retail rotation into what I call kopitiam logic staples. Everyone knows the chocolate business is stable, but this price jump is not backed by any material change in regional consumption data. When a stock moves this much on light volume, it creates a massive liquidity risk. If you need a quick exit because the macro environment changes, you might find there are no buyers at these elevated levels. The fundamentals just do not support this sudden surge in valuation. To wrap up the gainers on slide 8, here is the forensic verdict. We are looking at a gallery of overextended multiples and yields that simply do not meet the floor. Oiltek is an overstretched momentum play. Yangtze is pure cyclical speculation. Centurion is a yield mirage, and Delphi carries significant liquidity risk. My advice is simple. Do not overpay for the hype. You must see the math behind the momentum before you commit your hard-earned Singapore dollars to these names. Before we go deeper, if this forensic breakdown is useful to you, the single most useful thing you can do for the channel is hit subscribe. It takes 2 seconds, and it tells the algorithm that data-driven SGX analysis deserves to exist. Now we turn to the warnings on slide 9, starting with our featured loser Zheneng Jinjiang. This is a balance sheet failure that has triggered a multi-threshold alert. The trailing yield has dropped to 3.83%, down from its 5-year average of 5.2%. More concerning is the debt-to-capital ratio of 72%. Utilities are supposed to be your safe haven, but when a utility is geared to the hilt and yielding less than 4%, the sanctuary has a hole in the roof. You cannot build a financial sanctuary on a foundation of debt. And let's be honest, this foundation is looking very shaky. The wallet impact on slide 10 is clear. A mere 10% increase in financing costs would likely force a distribution cut just to keep that 72% debt ceiling from breaking. With interest rates remaining sticky in regional credit markets, the squeeze on China-centric utility debt is accelerating. For a heartland investor, your return here is effectively 17 basis points below the risk-free CPF special account. You are bearing the weight of 72% debt exposure for a return that is worse than zero risk. This is the definition of a bad deal for a retirement portfolio. Slide 11 brings us to a heavy hitter, Singapore Telecommunications. It is down 2.2% this week, but more importantly, the yield has dropped to 3.73%. This fails my mandatory yield hurdle of 4.7%. When an income asset fails to beat the 4.0% CPF floor, it becomes a dead weight asset. For long-term holders, the income shortfall makes Singtel a difficult name to justify in this current cycle. It is a hurdle failure that signifies the blue chip sanctuary is starting to crumble. On slide 12, we look at First Resources, down 1.7%. The yield here is 3.80%. While some market models suggest there might be an upside, the income forensic is very clear. It does not pay the 150 basis point risk premium I require for a commodity play. In the heartland, the risk of a sudden dip in palm oil prices far outweighs this subpar yield. This is a value trap where the headline price looks cheap, but the compensation for the risk you are taking is nowhere to be found. Slide 13 covers Raffles Medical Group, which has been stagnant. The yield has compressed to 2.45%, which is significantly below my 3.2% forensic floor. I call this a fortress without yield. The balance sheet is undoubtedly strong, but as an investor, you are being starved for cash flow. This position has not crossed the monitoring threshold required to earn a place in a disciplined retirement portfolio. So what does this mean for you? It means your capital is sitting idle when it could be working harder elsewhere. Summarizing the losers on slide 14, we see a group trapped in a yield no man's land. Zheneng Jinjiang is a multi-threshold failure due to its debt. Singtel is a hurdle failure. First Resources is a value trap. And Raffles Medical represents a sub-floor risk. These names are stuck between a falling T-bill rate and the solid benchmark of the CPF. They are not providing the safety or the income that a Singaporean investor needs to stay ahead of inflation and retirement costs. On slide 15, I want to explain my forensic yield spread monitor. I apply a conservative floor of 3.2% because we audit for the storm, not just the sunny day. Even though the T-bill has dropped to 1.47%, I do not lower my standards. My floor remains at 3.2% to ensure these assets can withstand a return to long-term average interest rates. To justify the risk of being in the stock market, I demand a 150 basis point risk premium. That brings the minimum yield hurdle to 4.7%. If we look at slide 16, you can see that every featured asset this week is failing that hurdle. Singtel, First Resources, and Zheneng Jinjiang all sit in the 3% range, which is above the floor, but well below the 4.7% threshold. Centurion and Raffles Medical are even worse, sitting below the 3.2% sanctuary floor. When every name on the list is failing to meet the minimum mandatory risk premium, it tells you everything you need to know about the current state of the SGX. The dominant theme here on slide 17 is the sanctuary gap crisis. As T-bill yields fall, investors are desperately trying to fill that income gap, but they are doing it with momentum instead of quality. They are abandoning stable but sub-floor blue chips like Singtel to chase unstable high PE industrials like Oiltek. The forward risk here is a double whammy. When those small cap multiples eventually correct, there will be no dividend support to catch the fall, leading to a simultaneous loss of both capital and income. My weekly verdict on slide 18 is that the blue chip sanctuary has failed. When the biggest names like Singtel and Raffles Medical yield less than your CPF account, the fundamental incentive to hold them vanishes. The market is currently trading, not investing. That 87 times earnings multiple on Oiltek is a siren song for the desperate, not a strategy for the disciplined investor. We are in a period where staying grounded in the numbers is more important than following the crowd. On slide 19, I want to share my personal forensic boundary. For my own portfolio construction, I am strictly tracking the yield spread of mid-cap industrials against that 4.0% CPF special account benchmark. If an industrial play cannot significantly out-yield a risk-free government account, it does not pass my audit. Remember, this is my personal boundary and my process for staying disciplined in a market that seems to have lost its mind. It is about protecting the principal first. As we see on slide 20, the window for action closes fast. In this volatile market, the difference between finding a sanctuary and falling into a yield trap is often decided in a single trading session. By the time this analysis reaches free subscribers, the entry or exit windows I identify have often already closed. The market moves quickly, and those who wait for the news to become common knowledge are often the ones left holding the bag for the institutional players. The numbers this week tell a story the headlines never will. If this forensic breakdown has changed how you see the market, you are already thinking like an analyst, not a retail punter chasing green candles. I am Iggy, forensic investor, ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. The full red zone watch list, the institutional grade cheat sheets, and this breakdown, Iggy's elite investors had all of it before the market opened. You should not be reading this 7 days after the window has already closed. Join Iggy's elite investors today, link in the description. This final slide contains the standard forensic disclaimer. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF SA or personal capital, please conduct your own due diligence or consult a MAS licensed financial advisor before committing funds.